Hello, this is Martin here from seekedge, the channel for learning about investing and trading. Welcome to the Risk Management for Trading series. Today we have a very interesting trading come investment topic that we're going to talk about, which is about gold. Investing and trading in gold. Look at the gold chart for the 30 years. No? You can clearly see the trend. No wonder why people are so bullish about gold. People, no matter what happens, people have this safe feeling that gold is secure and is good for long term. The reason is very much seen from these charts, where you can see that from last 30 years, 1975, when the gold costed probably for 1 gram, this is 1 kilograms cost that it is returned. So if you see that, you can see this is 1 kilogram, it's divided by 1000, if it comes to 4500. So that is what the rate, 4500 per gram is what the rate right now. So if you look at somewhere in the 2006 or 7, that rate would have been 1250 per gram, somewhere in that range. So it is multiplied several times in just a decade or so. So that's the kind of, and it is very rarely has it fallen, hardly few years in this 2012 time frame, 13. That's the only small dip that you can see. Apart from that small dip of 1 or 2 years, right? It has never really gone down, and it is considered to be consistently going up. So we are not talking about an instrument or an asset like gold. We are not talking something about something that is newly introduced. It has been there, considered as valuable since generations, even before 30 years also. 30 years data is only plotted here by this gold price.org, right? But gold has been there since several thousands of years. It is considered to be precious. So if this is an analysis of gold against equity, what if someone had invested in equity, and then what if other person has invested in gold? You can clearly see that even when times when the gold is, when the Sensex or the equity or the stock exchanges, stock market has gone down, you can see that gold is given reasonable good investment. So most of the times when market does very bad, that is when gold really performs, right? Some very rarely in 1 or 2 years both might have gone down, but overall, if you look if you compare the returns, look at 2019's return. 14% is all that you can get from investing in the index of the in the equity, and here you get 24% 2019, right? In 2020, what is the return? Comes to 40, above 40%. Is what the returns that we get. The right side, you see the Nifty and the gold, which is in the orange color. You can see that even the corona crash, when the entire market fell down, the gold went to the all-time high of, right? And then it, after the market catched up, it just slightly consolidated, right? Even in 2020, that's what you see. So gold has been outperforming or performing when equity was not doing good, and overall you can say that it is this chart and this information itself for the last 10 years itself shows that gold is giving very good returns, as against investing in the stock market. If you consider, this is if you consider a layman, not a trader expert, or if a layman person, if you had invested, not an expert trader, right? So gold returns, if you see historically from 1980, right, so many years, since 1980 onwards, if you see that, you can, the historical annual returns as published by the ET Money, if you see that, you can see that it is, right, this beating the inflation. The inflation rate is 6 and this beating that. You can see that it has been consistently almost throughout. It has been consistently. 2020 it's saying 45% return. 2010 it is 42, 46. So just been consistently giving reasonable return. It's a long term, as a long term investment, gold is giving very good returns as a equity, as against nothing. Individually if you take gold also, it is giving constant returns over the period of time. So these are some of the fundamental reasons that I'm just quickly, most of which but I'm just touching upon the fundamental reasons why people invest in gold. It's like hedging against inflation. You've already seen that, right? So inflation, prices increases, and inflation, economy is down. So this is a time when gold will give returns. It's a time when it performs. So it's considered to be a safer investment option from long time, right? Whenever uncertainty is there, you can see that gold has been giving good returns. Third factor is the liquidity. Liquidity is anytime you want to sell gold, there are people to buy, right? That's the most important thing, right? It's not like a fridge or a TV or some item that you bought and then if you want to sell, it's considered as second hand, or nowadays that, but gold always has the value, although there will be some charges that they'll take, right? So that's the liquidity aspect of it. It is a risk reduction and diversification. That is another fundamental reason, right? So all your money, if you put in stock market, stock market goes down, you are dead, right? You are doomed. So gold is a very good instrument that is used for diversifying your portfolio. Okay. Now gold is not oversupply. There is an organization that controls that. There is supply constraints are there, and there is a large demand from the jewelry and investment perspective. There is a huge demand, and supply is restricted. So that is another reason why gold is there too long. Is there on the long term basis to get to stay. Currency weakness, you can see, the currency we can see, rupee is now 75 plus levels. It's going towards that. Dollar also weakens whenever prices come. But gold is a hedge against all that inflation, currency weakness. So currency weakness is one of the reasons why even the governments have convert lot of the lot of their deposits and for into the gold, right? Just like how it is done, converted into the currency. Nowadays it is stored in gold. Even the government accumulate that. So these are all fundamental reasons that we already know. Now let's look at the technical reason. See here, this is the latest gold chart. It's within the chance. Weekly chart, you can see that it broke out, did not sustain, fall back, and then again it's slightly moving up. So it's not ready to go down. It doesn't go down like that, right? So that's what you can clearly see from the charts. It's the latest weekly charts. Now another very interesting, the primary reason why I thought of creating this video is this chart. This chart is very bullish. This is a monthly chart of gold. If you see, you can see very clearly that there is a rounding pattern, a cup and handle pattern, that is what it is, which is very powerful because it's on a monthly long-term basis. So this right now is consolidating around an area. After a dip, it rose up, and then when here it looks like a cup and handle, right? Now it is high chance that it will consolidate for some more period of time, which may be several months or maybe up to a year also. It can consolidate like this, and then it can shoot up. So we are very close to a breakout, is what the reason why I made this video itself. I'm very bullish on these charts. So this clear gives an indication from the technical point of view, in addition to the fundamental reasons that we already know. Sorry. Now, traditionally people have been buying the gold coins or buying jewelry and ornaments and keeping it at home, or lockers, and pay the money to the banks, and that's how gold was consumed. So nowadays it's not like that. There are different ways that we can invest in the gold. It may not be physical gold also, right? So gold ETF is exchange traded fund. It's similar to mutual, but more advantages than that. So that is one way of investing. There are exchange traded funds that's there by SBI and different organizations like Nippon. So GOLDBEES is an example by the Nippon company, right? Another way of investing is bonds. Gold bonds are issues. Right now we have this sovereign gold bonds that is issued by the RBI, which is the safest option. Now, gold mutual funds are by different companies. SBI Gold Fund, it's available. Now, commodity exchange like MCs, we can trade future golds, just like we trade any other instruments, right? Now, finally, the last option is buying golds or digital coins and all these things, right? So, we will look at each of this and see which is the best options for us. So, different ways and means are there for us to invest in the gold, right? So, these are the gold ETFs, that you can see SBI has got that, and the values, right, price details are there. So, Nippon ETF gold is what liquid base is. No, not Nippon's ETF is um, yeah, so that is gold ETF. Nippon, yeah, that is GOLDBEES actually. It's not, yeah. So no, that is done given by the Nippon company. So in many, so it's a different ETF. So the thing is, what is the price that is required to accumulate that? What is the liquidity is what you have to consider whenever we are buying ETFs. In that, Nippon is on the top. Nippon ETF GOLDBEES has got very good and very low investments. Hardly 41 rupees you have to spend. You can buy a unit of that exchange traded fund of gold, right? And you can buy up to it. Can also ETF also can be uh, you can get it on delivery also, just like stocks, or you can do that also, but it's a tedious process. Nobody goes for that. Where you are required to spend a lot more money, and then had to be in the Mumbai and things like that, right? It's a very tedious process of doing that, but just for information I'm saying. So gold ETFs, gold funds, just like mutual funds. So mutual funds expense ratios are also mentioned, varies, right? The terms and conditions vary. It's like just like any other mutual funds. Aditya Birla, Axis, HDFC, ICICI, all of them have got gold funds. Now, what is good? So sovereign gold bonds is the safest. It has got 2% that government is now that RBI is giving every year, 2% as interest, right? And then we get to buy it at a discount rate of per gram basis, 4,500 per unit, something like that, right? So all details you can go to the sovereign gold bond. If you type Google, you will get that, right? That gives very attractive tax benefit, and returns are also good, right? So the market price accordingly, this is basically used for long term. You'll have to invest at least for 5 years and redeem, and then only you'll get the tax benefit. If you break it before that, you'll have the tax issues, right? So that is giving an interest to 2.5% on top of the bond at the rate of what is the rate in the market while you are selling or redeeming it, right? So that's very attractive, safe, and has tax benefits, right? Gold ETFs, if you are putting it for short term, not for 5 years, 2 3 years, 1 year, 6 months, if you're kind of trading, then gold ETFs are the best. We have seen that Nippon is GOLDBEES is the reasonable price, and you can that advantage for investors is small investors, that you can buy it for even 40 50 rupees, 41 rupees, 42 rupees, you can buy 1 unit of GOLDBEES, and you can slowly accumulate. You can keep on buying that and slowly accumulate, and then that itself will be giving around 3 or 4%, 3 to 4% of return annually, right? When the price of that ETF of 42 rupees keeps on raising, your asset, also your investment also appreciates accordingly, right? So it has got less expense ratio if you gold ETF. So this is what are the two ways. Short term, go for gold ETF, GOLDBEES, or any other gold ETFs. But look at how liquid they are. Bid ask, if you go, you can see how liquid they are. Then long term, go for sovereign gold. These are not recommendations. Right? I'm not a registered advisor. Have a discussion with the financial advisor. So liquidity, taxation, cost, and risk. These are a few things that we need to consider when we are talking about going for investing or trading in gold. Right? So liquidity, what does that mean? Right? are we able to dispose of the asset that we have purchased and then come out of it, right, quickly and fast. So this, if you see sovereign gold bonds, it may not be easy to do that quickly. Sovereign gold bonds are purchased from authorized banks or brokers, like for example, so we already seen that it can be done. So we purchase that, and then if you're trying to dispose it off, since it is added to your Demat account, corresponding broker's Demat can be traded in the trading terminal, but you may not get the good bid ask, right? There may not be buyers, no, when you're trying to sell it off quickly. It may take several hours, sometimes half a day or all day. You'll have to wait for that to get filled, right? That is a problem with the sovereign gold bond as of now. But it has improved a lot. There is liquidity. You can sell off, but it may not be as liquid as you may expect for just like other stocks. But mutual funds don't have that problem of liquidity is not there. In the other ETFs also, it's very good. You can, it gets immediately get filled in the case of gold ETFs like GOLDBEES and all that, right? So there's no issue there. But this issue is something that you have to take note. Another thing is the risk. RBI's sovereign bond is the safest risk guarantee that gives the money. Also, they're giving 2.5% as interest per year, which is on top of what you gain from the price movements of the market. The only problem there is you'll have to wait for long term. 5 years at least, if you don't invest, you don't get the tax, but you'll have to pay the capital gains tax, right? So safety wise, if you see, sovereign bonds also has the market fluctuation risk is always there, right? That is there for mutual funds more, because we don't know how they are investing. But RBI is solidly investing only in gold, right? Gold funds, how they are managing their funds, we are not sure, right? There is risk of additional risks is all there. Comparatively safest is RBI sovereign bonds, you can say, right? Now, ETF has got expenses. The cost of purchasing is another thing. In addition to what you invest, that amount, there is a cost for this. ETFs, it costs 0.5 to 1% is expense ratio, charges and all that. Now for mutual funds, it will cost more, but up to 1.2 also some mutual funds. So it depends. So the cost is more. ETFs, that's why ETFs are suggested, since the cost involved is less for the exchange traded funds. Now the capital gain tax is something that that you have to pay for all the ETFs, mutual fund, bonds, everything. But in the case of government bonds like RBI sovereign bonds, you get the tax rebate. You don't have to. The taxes, it's tax free if you are putting it long term. If you are redeeming only after 5 years, there's no problem. But 2.5% interest that they give, RBI sovereign bonds gives, that will be taxable, right? So that is what these are things. The risk is least, cost is more, taxation is less, liquidity is less. So this is what sovereign gold bonds are there. So this is the trade-off. This is the assessment that you have to do before you decide, right? So if you want short-term investment, it is the best, right? So you have to trade off between this. So how do you? So the question that beginners have is, how do you trade this? I already mentioned that sovereign gold bonds. If for example, if you take, how do you buy that? So it is not issued every now and then. Okay? Whenever the government thinks of procuring gold as an asset with RBI, they will issue that. So it may be multiple times in a year, multiple years. Sometimes no year, some years they may not. But they will help. They will give notifications for doing that. They will have authorized banks and brokers. For example, so the coin, we can go there, we will see the bonds available and we can purchase it. There will be restrictions on the amount that we can put in that, right? You cannot buy hundreds of thousands of kilos. There will be some restriction that is there, but the normal person, if you want to purchase several lakhs, there is no restriction there. Even up to crores you can buy, right? So bonds, that's how we buy. So once it is bought, after 15 days it is allocated, right? Then it gets added to your Demat account and it will be just like any other stock in your holdings. It will appear in a holding, you can trade and sell it off. You can trade by just typing. If you can see here, this is another kite platform, you can see that just type SGB, sovereign gold bond, SGB, and then the particular other details of the month and duration and details of, along with that, if you purchase, you can exactly pinpoint the kind of the bond that you purchase, which year, what, and then by add that to your basket and then sell it off or buy, right? Depending on the bid of trust, who seller is there, it gets all complete. So it's the same process of buying. So Exchange traded fund, for example, is the same. Go to your terminal, type GOLDBEES. You will have that product come, you put the quantity and then you purchase. So every broker will have some platform or other like coin. For example, Fyers direct, or you can buy them. But Fyers, they don't provide to sovereign gold bonds. Right? So each broker will have their own means of providing the mutual funds or the bonds or the ETFs. All this is available just like any other stock. You can trade the exchange traded for the mutual funds and the sovereign bonds. Now, another question that beginners would investment new to investment would be asking is how much should I allocate? So have so and so capital and so and so money is put into equity, so and so into asset, real estate and things like that. So what the financial experts say is that it should be half of your age. If your age is 40, then 20 is percentage of allocation that you give. 20% of your total portfolio should be allocated to gold is what they say. If you're 80, then 40% should be. So the more age you have, more allocation should go into the gold is the financial recommendation. Now, why we like particularly, we are not recommendation, we are not financial advisors once again, right? Consult your financial advisor for anything, any kind of investment or trading that you do. But why we like, for educational purpose, why we like gold as an investment? Reasons are hedged to inflation. So inflation keeps on right now, inflation is picking up, right? So that keeps on rising, then it comes down, then it again picks up. So whenever there is inflation and price increase and all the related troubles are there, gold will always act like hedge. Gold will perform well. Whenever market is down also, gold usually performs well. So gold is the inflation hedging tool. Now risk diversification, that's the main thing that why we have included gold in the risk management section. So it reduces the portfolio risk. You invested everything into one basket and then it burst off and then you are nowhere. So you reduce your portfolio risk and then by diversification, and gold is the best diversification tool. Safest and the best diversification instrument or asset class, you can say. Right? And it gives good long-term returns. We had already seen in the previous slides that it gives the best returns. Irrespective of uncertainty, even Corona, everything, when entire world went upside down, gold shot up. Right? When our stock market goes down tipsy, gold is giving us returns. We already seen that. Now, tax benefit is another thing. If you're going for long term and then go for government bonds, then it gives tax benefit. Now, another very attractive thing is if you're a trader and you're trading derivatives options, you can use this as a collateral with a small haircut. Now, almost all the brokers provide that. GOLDBEES can be put as collateral. Gold funds, small mutual funds, all can be used as a collateral. So the gold will appreciate, your investment will remain there. You can leverage that also. Okay. Now, if you don't want, say, in addition to the pledging, long-term investment, tax benefits, right, risk diversification, all that, you can make small investment. Trading can be done in exchange traded funds and GOLDBEES. Even at a small level, small amount of 41, 42 rupees, you can buy, right, with ETFs. That is a big advantage that we have nowadays, right? In the exchange traded funds and mutual funds and the gold bonds everywhere, it is mapped to every 1 gram movement of the price in the market. That is how it is calculated. So the market gold price improves, here also it improves. Market gold price reduces, here also it reduces. Right? So the only difference is that RBI bonds are giving interest on top of that. Okay? So these are the reasons. Now the primary reason, which is not mentioned here, right? Why it's gold is that gone are the days where we pay we buy gold only for as a ornament and then pay the bank the locker fees and then pay the jeweler all the making charges and all kinds of charges and don't get what it is actually worth in the market, right? What are those days, right? Very people still know about options like exchange traded funds where you can buy gold at a very low price also. So you can do SIP and you can accumulate and invest and create a fund of your own, which can be used for further trading or as a portfolio diversification, whatever. You can go to very lower levels. Again, there are options of safe and secure and good return without actually buying and keeping the gold. So this is not aware to a majority of the people who are staying out of the stock market. So that's all I have. So please share this to your friends, relatives, family members, and others, so that they also benefit and then come to know that there are instruments and asset classes like this which are risk free and can be traded as easy as you do any other stock or mutual fund. Right? And there are better options like exchange traded funds which are better than mutual funds with less expense ratios and less amount of investment required. Right? Still, you get the market fluctuation benefits. Right? So kindly subscribe and give us feedback, and then share the link, so that we get more subscribers in this YouTube, and then we get more motivated to give you more better content on trading and investment. Happy learning and happy trading. Thank you.